Good morning, good afternoon, good evening, and welcome to Martyn Lucas Investor. It's the Wayfair earnings as requested by one of my members. If you're one of my members to my channel and you request an earnings or a stock review, you get it. So that's why we're here up early this morning with Wayfair earnings. It's a slight beat. The market is up 6.25. We are just 4 minutes away from the earnings call. This is the earnings call. We're getting ready to go in just a few moments time. So we're listening in. We've got the audio. I'll double check the audio is still good. Yep, we're still good coming through. We've got another 4 minutes to go before the Wayfair earnings. As you can see, this is the market. The candles have done well and everything's up 6.25. Some buying coming on. Let's have a closer look at the position. Here you go, 51.83. If we look, we can see that it's above the RSI at the moment, overbought. And we can also see the sentiment of the stock. Looks like some profit taking now. This is level 2 data. You can't believe this. You can't trust this. It's very heavily manipulated. I've tested it many times. That does not tell you what the stock's going to do. Of course it doesn't. If it did that, everybody would be making money all the time, and of course it wouldn't work. The system has to work like this. It's not always obvious what's going to happen, otherwise it'd be like predicting the future, right? Anyway, welcome everybody. Good morning to everybody, and welcome all. Right, let me just check all the streams are looking good. Let me have a look around the studio. Everyone's present and correct. Great stuff. We are buffering again this morning. We've had a few issues recently, and I've no idea why. I cannot work out what the issue is. There's nothing wrong with my system at all, but YouTube just seems to be buffering when it's receives the signal. Welcome everybody over there on TikTok this morning. Good morning to you. We've got a big giveaway coming up this weekend. We're giving away $100. In cash on our live show, so on YouTube. So if you want to be part of that, you can. Love to have you take part. It's free to enter, free for all. You haven't got to do anything. You haven't got to buy anything. Just join us on the show. Come out of the live show. Click the little icon here. Click it twice, and you'll see my links to my live show. Come in and say hello. All right. We're live now on YouTube and Rumble. This is the main broadcast. You're watching my phone, look at the broadcast. So if you want to join us, we are giving away $100 this weekend. It's completely free. Come on in. Right, we've got 1 minute to go before the Wayfair earnings. So get ready. We're going to be tuning in just a couple of seconds time from now. So let's get ready. So, we're just a few seconds away now. I'm going to start bringing the audio in so we know it's working. Here we go. We're going to start listening in now because last night, NVIDIA, incredible, actually started within 5 seconds of time. Never happens. Everybody's normally late on earnings, but they were absolutely spot on, which absolutely amazed me. Anyway, let's bring in the audio. Let's put it on mute. There you go. I can hear it. You can't for copyright reasons. There's no audio at the moment that you need to hear. They're just playing music. Okay. Let's get ready to go. Just a few minutes away now. Wayfair up 6.25%. We're listening in. I can hear the audio. We've beaten on earnings. We know that much. Okay, it's gone 7 o'clock a.m., so any moment now. I will unmute it as soon as it begins. Typically, we're 1 or 2 minutes late on average. The worst was about 25 minutes. Last night was the best ever. NVIDIA were 4 seconds. which is incredible. Okay. Here we go. Just listening in now for Wayfair earnings. We're on mute. No, they teased me there with some more music. Any moment now the earnings will begin. So we're just listening in. If you've just tuned in, click subscribe, ring the bell. Their audio is very, very quiet, but I can hear it. In fact, let me give them some more volume. Just a bit more there. We're just waiting. We're just 1.5 minutes now over time. Any moment now. Wayfair earnings. If you've just tuned in this morning, click subscribe, ring the bell, tap the like button. Lovely to have you here. We are tuned in for the Wayfair earnings. Sri Ram has just requested MTBL. We're not taking any free requests at the moment. As a member, you get, I will do you a free review. However, we're not taking any on the free list at the moment because it's too long. People have been super chatting to get above the list. So I still have a few to do. Later on today, we've got DM, Desktop Metal. We've got Nano Dimensions and Life Sciences before we go back to the free list. And I can't add any to the free list at the moment because it's so long. So sorry about that, Sriram. If you want to jump the list, you can. But with a super chat. But unfortunately, we can't add any free ones as there are so many requests. Okay. We're listening in. They're playing the audio. Any moment now, the conference will begin. The latest we've ever been was 20 minutes. This is 3 minutes late now. NVIDIA last night was precisely on time. And I can hear the audio. I've just got it on mute at the moment. Okay, we're listening in. All we can do is listen in at this point. We'll be with you shortly. Wow, they're quite late. This is 3.5 minutes now. Not good. But there's nothing we can do about it, I'm afraid. We just have to wait. We're still listening in. 51.79. I'll share with you the stock movement. Oh. Here we go.
This time, I would like to welcome everyone to the Wayfair fourth quarter 2023 earnings release and conference call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during this time, simply press star followed by the number 1 on your telephone keypad. If you would like to withdraw your question, again, press the star 1. Thank you. James Lamb, Head of Investor Relations and Treasury, you may begin your conference.
Good morning, and thank you for joining us. Today, we will review our fourth quarter 2023 results. With me are Neeraj Shah, co-founder, Chief Executive Officer, and co-chairman, Steve Conine, co-founder and co-chairman, and Kate Gulliver, Chief Financial Officer and Chief Administrative Officer. We will all be available for Q&A following today's prepared remarks. I would like to remind you that our call today will consist of forward-looking statements, including, but not limited to, those regarding our future prospects, business strategies, industry trends, and our financial performance, including guidance for the first quarter of 2024. All forward-looking statements made on today's call are based on information available to us as of today's date. We cannot guarantee that any forward-looking statements will be accurate, although we believe that we have been reasonable in our expectations and assumptions. Our 10-K for 2023 and our subsequent SEC filings identify certain factors that could cause the company's actual results to differ materially from those projected in any forward-looking statements made today. Except as required by law, we undertake no obligation to publicly update or revise any of these statements, whether as a result of any new information, future events, or otherwise. Also, please note that during this call, we will discuss certain non-GAAP financial measures as we review the company's performance, including adjusted EBITDA margin, and free cash flow. These non-GAAP financial measures should not be considered replacements for and should be read together with GAAP results. Please refer to the Investor Relations section of our website to obtain a copy of our earnings release and investor presentation, which contain descriptions of our non-GAAP financial measures and reconciliations of any non-GAAP measures to the nearest comparable GAAP measures. This call is being recorded, and a webcast will be available for replay on our IR website. I would now like to turn the call over to Neeraj.
Thanks, James, and good morning, everyone. We're excited to be with you today to discuss our fourth quarter results and recap 2023. Q4 was one more definitive step on our profitability journey as we generated a 3% adjusted EBITDA margin, even in a difficult macro environment. This was our third consecutive quarter of positive adjusted EBITDA and free cash flow, and a reflection of the immense progress we achieved across the entire year. In fact, on a revenue base that largely mirrored 2022, our free cash flow in 2023 improved by over $1 billion. As we exited 2022, we anchored ourselves around three core initiatives: nailing the basics, driving customer and supplier loyalty, and cost efficiency. Over the course of 2023, we systematically executed on all three fronts. Our efforts to nail the basics and drive customer and supplier loyalty led to a large improvement in our core recipe across availability, speed, and price competitiveness. The improvements across our offering were directly responsible for the step-up we saw in loyalty, which manifested in our robust share expansion over the last year, and by the fourth quarter, a return to year-over-year growth in our active customer count. That engagement was driven in part by our progress on the third initiative, a meaningful evolution in our cost structure, with savings spanning labor, operations, and every other line of our P&L, which allowed us to reinvest in our customer experience. We've consistently shared that those same core initiatives would carry forward into 2024, and you've already seen the results of that play out. If you haven't had the chance, I'd encourage you to take a look at our shareholder letter that was published alongside our earnings results earlier this morning. Last year, we saw our team unlock large productivity gains as focused execution against our top ideas met reduced friction and less internal bureaucracy. As we look at the evolution and composition of our teams throughout 2023, it became increasingly clear to us that there was more that could be done to increase productivity. We realized that many of our teams were still over-indexed to middle and upper-level managers in proportion to the more execution-focused team members that are the foundation of each group. Late last year, we started an exercise involving a number of our senior leaders to look at each team across the organization and answer some simple questions. How would we maximize the efficiency of this team? How many people would be on it? What would the appropriate leveling look like? Would we actually prioritize all of the activities the team does? And then we answered as if we were starting from a blank slate. We took this work and used it in conjunction with the effort we started in the summer of 2022 to return to our lean and fit self by reorganizing around an ideal structure. While this is not the work anyone enjoys, being lean is a key part of our culture and partly why we think we've out-executed others over the last 20 years. The key here is that we're comfortable being frugal around headcount. We're excited to welcome a group of new college graduates this summer, and we'll allocate those hires to the key teams and efforts that will provide the biggest gains, all the while growing the foundational base of talent in the company who can rise through the ranks in the years to come. This enables us to move forward against an ambitious set of growth initiatives, while at the same time see our team thrive in a workplace where they have fewer obstacles, fewer meetings, and fewer boxes to tick off to bring these initiatives to fruition. Many of you asked if the decision was made in reaction to what we're seeing from the macro, and the answer is no. Our intent was to address the structure of our org in a way that will unlock productivity gains, not just for 1 or 2 quarters, but for years to come. However, as we shared in our press release from last month, our category does remain challenged with softness persisting through the start of the year. I was recently at the furniture market in Las Vegas and had the opportunity to speak with many of our suppliers. We heard that January was weak, though a short bout of extreme weather was clearly one factor. While uncertainty remains around the timing of a recovery, we are well positioned to see meaningful upside as the spending climate around the home and housing rebounds, and we continue to see our own growth well outpacing the category. It's important to call out that our success is not exclusively against smaller home-focused competitors. We're also seeing share gains against some of the biggest retailers in the country. I mentioned earlier that we've been able to win through execution gains driven by a more nimble, focused team, and we've been encouraged to see that play out across the organization. One area that I'd like to highlight today is our UK business, where we've seen a noteworthy inflection in share over the past year. The UK is a key market for us with an addressable market estimated to be in the $60 billion range. While the competitive ecosystem has strong similarity to the US, with a mix of a few multinationals, a number of large multi-category retailers, several homeware specialists, and a long tail of smaller competitors in various niches within the category, the actual list of names looks almost entirely different. The market fragmentation works to our advantage, as we are one of the few scaled players that focuses exclusively on the home. Over the past year, we've driven healthy market share growth on the back of considerable availability improvements, double-digit percentage growth in small parcel speed badging, and meaningfully more competitive prices. This was fueled by our operational efficiency initiatives that drove considerable savings dollars, some of which we were able to pass back to our customers. Our aided awareness in the UK is nearly as high as the US, and we've seen an encouraging increase in customer satisfaction scores since the same time last year. Just as we do in Canada and Germany, we take a country-specific approach to servicing customers in the United Kingdom. Our creative is specifically built to emphasize UK tone of voice, along with using UK homes in our television ads, which you can view on our UK-specific social channels. Leveraging our strength in logistics and our 6 UK Wayfair delivery terminals, we bring our UK customers a best-in-class fulfillment experience with services like scheduled delivery and white glove upgrades, while also opening up a wider selection from suppliers based in continental Europe. We find that UK competitors frequently have much lower levels of selection, which makes our endless aisle even more compelling and positions Wayfair as an unparalleled option in the market. Now, before I hand it over to Kate, I want to take a few minutes to address 3 of the topics around which we've heard the most interest. Let me start first with the Red Sea and ocean cargo situation, which we've gotten many questions about over the past couple of months. Like many others, we've seen some supply chain disruption, especially for our product being shipped to Europe through the Suez Canal. We've seen our carriers implement interim solutions, including routing shipments around the southern tip of Africa. It's important to keep in mind the minor scope of supply chain disruption this poses in contrast to the type of disruption we faced back in 2021. These new routes increase shipping time on a much more manageable basis than we faced in 2021, and availability across our catalog has seen no meaningful negative impact. Container prices have risen, but nowhere near the order of magnitude the industry faced a few years ago, when rates reached $20,000 per container during the COVID crisis. So the net is that while rates have risen, it is something we're very capable of managing without issue, and we're already solving for that today. The second topic we've received questions on has been average order values. We know this has been tracked quite closely in recent quarters as the inflationary pressures for many of those same supply chain challenges have now finally worked their way out of the inventory picture. Our AOV peaked in the second quarter of 2022, and by the end of that year, we began to see prices decline. We lapped those initial price drops this Q4 and saw that normalization process happen a bit more rapidly than we expected, due in part to mix shift. We still anticipate seeing some modest negative year-over-year comparisons during the front half of this year, as we approach a fully normalized pricing state mid-year. The third topic we know investors are acutely focused on is the volatile macroeconomic backdrop, as the category quickly approaches a new record for a peak-to-trough correction. As we said consistently, our focus is squarely on controlling the controllables. You've seen the enormous progress we've made on our cost structure in the last 18 months. As part of our press release from January, we called out that we would expect to generate over $600 million of adjusted EBITDA this year on a hypothetical flat revenue scenario, which would translate to a margin north of 5%, putting us in a position to check the box on step 2 of our profitability ramp. And that only captures part of the substantial leverage we've unlocked in our model, with our true earnings profile further augmented by the reductions we've brought to bear on equity-based compensation and capital expenditures. With all the work we've done to optimize our fixed cost base, we'll see even further benefits to the bottom line when the category recovers, as the high margin on flow-through of each incremental dollar of revenue will drive up the margin rate quickly. It's important to reiterate that our work on cost savings hasn't deterred our focus on delivering a best-in-class shopping experience. For example, we recently launched free white glove delivery on certain large parcel items, which we combined with deluxing, where our delivery agents unbox an item, inspect it for any flaws before the final delivery, and greatly enhance the customer experience to seamlessly set the item up in the customer's home and make sure it's immediately ready for use. This is only possible to provide nationally with the scale and focus that Wayfair brings to the category. And it's one of the many factors behind our return to positive active customer year-over-year growth this quarter. We're eagerly looking forward to demonstrating the growth potential of our business as the category recovers. And I want to end by calling out some of the things I'm most excited for in 2024. The first is the launch of our Wayfair branded store this May. We're delighted to showcase the breadth and depth of our catalog in an entirely new way and can't wait for you to see it. The second is the launch of our new brand campaign, which will roll out in mid-March. We're bringing a vibrant refresh to the Wayfair brand with new merchandising, new marketing, and new ways to connect with our shoppers. And the third is our plan to launch a tender-neutral loyalty program this fall, a new opportunity to create a differentiated shopping experience for our customers to keep them coming back time and time again. We have a lot of exciting things underway to help us keep driving compounding gains. With that, let me turn it over to Kate to walk you through our financials.
Thanks, Neeraj, and good morning, everyone. Let's dive into our fourth quarter results, beginning with revenue. Net revenue for the quarter came in at $3.1 billion, up 0.4% from the same period last year. Orders grew by 2.7% year over year, and we saw active customer growth return positive, up 1.4% year over year in the period. As Neeraj discussed earlier, average order values came in higher than expected, down only 2.5% against the fourth quarter of last year, as we saw a boost from our performance in higher ticket classes during the holiday shopping season. I want to touch on the top line and macro context a bit before going further in the P&L. As Neeraj shared in his remarks, our category broadly remains under pressure. Within this context, we are very encouraged by our ongoing share gains and our continued ability to outpace the category. We've started this year with the best share figures we've seen across all the data we have in our credit card panel back to 2018. As we've shared previously, the share capture can be attributed to the return in strength of our core recipe in Q4 of 22, as we improved availability, speed, and price, driving a best-in-class customer experience. All, of course, in the context of also aggressively managing our cost structure and driving profitability and free cash flow. I'll now move further down the P&L. As I do, please note that the remaining financials include depreciation and amortization, but exclude equity-based compensation, related taxes, and other adjustments. I will use the same basis when discussing our outlook as well. Gross profit came in at 30.4% of net revenue, as we saw the typical effects of holiday seasonality play out in tandem with our own proactive reinvestment of some operational savings that we had achieved earlier in the year. Customer service and merchant fees were 4.2% of net revenue, and advertising was 12.2% of net revenue. Once again, there is a holiday effect here, which drove the sequential step up in advertising dollars spent. Finally, Selling, operations, technology, general and administrative costs, or SOTG&A, came in at $447 million for the fourth quarter. That was the impact of our work in 2022 and 2023 on driving fixed cost efficiency. We took SOTG&A down by over 13% in the full year 23 versus 2022, and that doesn't even capture the progress we made on reducing capital expenditures and incremental dilution from equity-based compensation. Altogether, we had a third consecutive quarter of positive adjusted EBITDA at $92 million for the period, or a 3% margin on net revenue. Our U.S. segment drove $131 million of adjusted EBITDA at a 4.8% margin on net revenue, while our international segment adjusted EBITDA loss of $39 million was less than half the loss we had in the same quarter a year ago. We ended the year with $1.4 billion of cash and equivalents and $1.9 billion of total liquidity when adding the capacity from our undrawn revolving credit facility. Net cash from operations was $158 million, which was offset by $96 million of capital expenditures for free cash flow of $62 million for the fourth quarter and our third quarter in a row of positive free cash flow. Now let's turn to guidance, please. We are continuing to win share among consumers, but see the weight of a category correction now rivaling the great financial crisis, dragging on top-line growth. To put this in perspective, our read of various data sources shows the category declining year over year now for 9 consecutive quarters, with the last 6 quarters exhibiting double-digit contraction. Although the timing is inherently uncertain, when macro pressures on our category and interest rates eventually ease, we are set up to benefit meaningfully on revenue growth and profitability flow-through. Moving on to gross margins, we would continue to guide you to the 30 to 31% range as the appropriate place to model. As we've said for over a year now, we intend to be very tactical in our decisions around investing some of our gross margin back into the customer experience. In light of the volatile start to the year for the category, we anticipate that we will continue to prioritize those investments. Customer service and merchant fees should be between 4 and 4.5% of net revenue, reflecting some of the cost takeout from the workforce realignment plan we enacted last month. We expect this to trend closer to the 4% mark as we run rate the full savings by Q2. Advertising should stay in an 11.5 to 12.5% range, and SOTG&A should be in a range of $410 to $420 million. Following this guidance through, we would expect adjusted EBITDA margins in the positive low single-digit range for Q1, which we would expect to be a low point both on a dollars and margin basis for the full year. While we don't offer full-year guidance, I want to refer back to remarks we made on our third quarter call. It is critically important for us to deliver on our commitment of substantial adjusted EBITDA growth in 2024. We have multiple levers at our disposal to drive adjusted EBITDA independent of the top line. Even if the macro environment remains challenged across 2024, we have line of sight to full year 2024 adjusted EBITDA growth north of 50% year over year. As you are modeling, it's worth bearing in mind that the first quarter is typically the period where we see an initial outflow of cash during the year, given our negative cash conversion cycle, which reverses as revenue builds in the spring. Now let me touch on a few housekeeping items. You should expect equity-based compensation and related taxes of roughly $110 to $130 million, reflecting the healthy progress we made on cost takeouts. Depreciation and amortization of approximately $103 to $108 million. Net interest expense of approximately $5 million, weighted average shares outstanding of approximately 120 million, and CapEx in an $80 to $90 million range. As I wrap up, I want to spend a moment addressing the topic of capital structure planning as we look out at the maturities coming due over the next couple of years. The meaningful improvement in our financial profile over 2023, in combination with the cost action we took last month, has given us broad optionality in managing the convertible notes that come due in the fall of this year and 2025. Looking out at the macro and our own cash flow profile, we are prioritizing prudency. Our goal, as always, is to maximize value to Wayfair shareholders, and we are extensively evaluating the best timing and options to achieve this. Due to the hard work of the last year, we believe we've expanded our option set. For example, the improvements in our pro forma financial profile enable us to pay down the notes in cash and remain opportunistic around any potential refinancing activity. Before moving into Q&A, I would like to return to what Neeraj touched on earlier. 2023 truly was a year of meaningful progress for Wayfair. Our market share gains and a return to active customer growth clearly show that we are the premier shopping destination for the home. This foundation positions us incredibly well to re-accelerate toward the growth algorithm we laid out at Investor Day once the category stabilizes. As importantly, we have made considerable improvements up and down the cost structure with a clearly demonstrated discipline that carries forward to 2024 and beyond. The combination of these elements, along with all of the exciting innovation we have in store, makes me more confident than ever about the bright future ahead for Wayfair. Thank you. And now Neeraj, Steve, and I will be happy to take your questions.
At this time, I would like to remind everyone, in order to ask a question, press star, then the number 1 on your telephone keypad. We ask that you please limit yourself to one question and one follow-up. Your first question comes from a line of Simeon Gutman from Morgan Stanley. Your line is open.
Hey, good morning, everyone. I wanted to ask first about the spread of your share gains vis-a-vis the industry. If you can contextualize it all, where, I don't know, e-com or total industry is trending, and then what gives you confidence that spread holds throughout the year or could even expand?
Yeah, thanks, Simeon. This is Neeraj. Sure, let me answer that. So first, on market share, obviously, there's a lot of ways to calculate market share. I'd say our main two ways we do that are we have a credit card data set we get, which has close to 100 competitors on it, and that gives us really good granular data at the competitor level and in total. The second is we talk to our suppliers regularly, and they share how we're doing, and they'll share details relative to specific competitors. And while that's less of a quantitative read, that's a pretty dense, detailed read, and so we use those two. But if you zoom out, the easiest one is just to look at our revenue, right? And if you zoom way out, you see our revenue was up, just under 0.5% in the quarter year over year. I think if you look at competitors, depending on the category you pick, you're going to see numbers -10, -15. You're going to basically see numbers even maybe higher than that. Some are going to be -20. That's where the category was year over year. So obviously that delta is the share that we took because obviously the revenue, is customers voting with their dollars. That's the market share. So we're, the way to think about it is for 5 quarters now, since the fourth quarter of 22, we've been taking share. And that was basically on the back of availability and price started to recover post-COVID in the summer of 22. By the fourth quarter of 22, we had that recipe back intact. So we very quickly started picking up the share, the low-hanging fruit of the share. But then even though that got hard, after that, as we hit all-time highs, we've continued to take share. And so our all-time high, we keep hitting all-time highs in market share as the quarters go by. And so what we would expect to happen is that you're going to see the category for a period of time, in the near term be challenged. So, the year-over-year numbers for the total category will be, not great. And you're going to see us outpacing them significantly, thereby picking up incremental share, continuing to hit all-time highs. So I don't know if that helps with the context of what we expect, but that's sort of the way we see it. And then the only other comment I would make is obviously we would expect the category to subsequently recover. It's a cyclical category. And, it was interesting. I was reading a note someone put out about the Home Depot call the other day. And Home Depot is obviously a well-run company, but obviously is in the home category as well. And they're talking about how certain segments are, challenged right now, what have you. But what the note talked about is how from a cost and a revenue potential standpoint, they're really poised for huge gains once the category recovers. And what I will point out is that's also how we feel we are. So in other words, we're taking share while it's really hard to take share as the market's, it's shrinking. It's a challenging time to take share. Obviously, competitors don't want to give up share. But we've taken up $2 billion in cost, close to it. We've gotten ourselves where the unit economics are very strong. We've got customers really responding to what we're doing. You see that in the market share. You also see it on the active customer count, which has ticked up. And so as the market turns and demand comes back, I think you're going to see quite a nice acceleration in revenue and profits as well. So while the market's tough, you're going to see us continue to tick away just with the execution we're doing, and then you're only going to see that get a lot better as the market recovers.
And to that point, and this will be the follow-up, as sales recover, what is the right way to think about incrementals for every point above zero? And then alternatively, if it stays negative for the medium term, is there a way to think about decrementals?
Yeah, sure. So I think the way to think about, so actually one thing I'll just put a plug in for is we today, along with obviously the earnings call materials, one of the things we released on the investor website is our annual shareholder letter. And, you know, as the title says annual, we only do that obviously once a year. So it's an opportunity to look out to the future and for us to share our thinking on a bunch of topics. And I really encourage everyone on the call to just take a few minutes to download that and read it. It's right on the IR website. Because there we can really share some detailed thinking about what we're focused on, which is not so much near-term focused as the call tends to be. But one of the things I do mention in it is how we think about how we're poised for future earnings. And I talk about how the next $1 billion of revenue would flow through in the mid to high teens on EBITDA. And, you know, that's basically the concept. You know, we have fixed costs in the business, and we get to leverage those as we grow. So there's, you know, that's hopefully your point on kind of, what's the incremental potential look like.
Yeah, and hey, Simeon, it's Kate. Good morning. I guess what I would add to that too, you know, you asked sort of going the other way. And in the prepared remarks, I referenced that comment that we made on the third quarter call around substantial EBITDA growth. And I said, you know, somewhat irrespective of the top line, we expect to see 50% EBITDA growth as really a floor. So even with, you know, ongoing challenging macro, or in your scenario, potential contraction ongoing, we would still expect pretty significant EBITDA growth in 2024 due to the cost actions that we've already taken.
Thank you both.
Your next question comes from the line of Alexandra Steiger from Goldman Sachs. Your line is open.
Great. Thank you so much. So you've been very clear that reducing headcounts over the past few months has been a driver of efficiency and productivity within the organization. Where are we in that journey? Do you think there's more room for efficiencies? And when do you think it's actually the right time to start rehiring, grow headcount again? And then my second question for Kate, could you just elaborate a little bit more on your Q1 revenue guide in terms of drivers behind the outlook and the factors that are inside versus outside your control? Thank you.
Why don't I answer the first part, and then I can turn it over to Kate for your second part there. On the kind of productivity, efficiency gains, headcount side, I think the way to think about it is we obviously did reduce headcount over the last 18 months. But this last time, what we did is we did it with first and foremost an eye to what we thought a very efficient organizational model would be. Versus a cost savings target or something like that as the initial going in goal. And so we think we've set up what will be a very efficient organization. There is some headcount we will add to that, but it's modest in the scheme of the headcount we have. And what it really does is it lets us really reformulate teams, including a lot of the more junior members of those teams, which during the COVID period we hadn't hired. And so we didn't have as many of those folks on the team as would make sense from a ratio standpoint. And so with the college hires will join, you know, we'll have them there. But that's from like an incremental headcount cost standpoint. You know, that's not a big number. And what we think is that there's a lot of productivity gains to come, and that comes from a few different things. One, it comes from, you know, with the organizational model we set up, we think it enables folks to move faster and get more done. We're already seeing early signs of that. Second, we think then, you know, a lot of people are in new roles. So then as they get settled in and as they're executing, we think there's compounding gains there. And then the last piece is we've spent a lot of the last couple of years on a technology transformation and replatforming our core technology stack. And as we're nearing the later stages of that, we get a lot of gains from when we build feature function on the new technology. It's much faster to build and much more flexible. And those gains will come in the future, but we're nearing that point. So we feel quite good about how productivity will continue to compound as we go forward.
Yeah, so Alexandra, on your revenue question, a few thoughts there. Obviously, the macro context is the macro context. We don't drive that. But we have been focused for the past 6 quarters on controlling what we can control. And as it pertains to revenue, a key piece of that is the recipe. So price, availability, and speed. You heard Neeraj speak to that. That's been driving our share gains. And we think we've done a really great job driving gains in what has been a challenging market. As it particularly pertains to this quarter, we're obviously sitting on this call, deep into the quarter at this point. And so I just point you to that as you think about, our quarter-to-date number, and referencing that is generally what to expect for the quarter.
Great, thank you.
Your next question comes from the line of Brian Nagel from Oppenheimer. Your line is open.
Hi, good morning. Thanks, as always, for all the details. So I have a couple questions here. I know the first one's going to be a follow-up. Just with regard to that, the guidance, the top-line guidance you've given here for Q1, should we interpret that to mean that, if you're down mid-single digits, that the backdrop for Wayfair has actually gotten more difficult here? And I recognize there's a lot of seasonality and such, but as we've gone from Q3, Q4, and then into Q1, has the backdrop actually gotten more difficult? And then my follow-up question, unrelated, Kate, thanks for all the details there with respect to the balance sheet. I guess maybe if you could help us understand better, you obviously repositioned the business extraordinarily well. You're in a better cash flow position. But how should we think about the timing of some of these actions on the balance sheet?
Okay, great. Brian. Why don't I, on your first part of your question, where you talk about, is the backdrop getting more difficult? I think what you're referring to there is, has the macroeconomic climate gotten tougher? I think that's kind of where you're going with that. And we would say yes. We would say that, the macroeconomic climate has gotten tougher. I think that, is what we just read comments from a lot of other retailers that have made public comments. That's what I think you're hearing broadly. We've seen that in the credit card data. And, I was at the Vegas furniture market, which I referenced earlier, and, January was particularly tough. Now, there was some bad weather in there that was temporal. So, things have gotten a little better since. But the market is softer than you would have, thought it would be if it was kind of like sequentially just kind of modestly seasonality adjusted flat. So I'd say the macro has gotten tougher, but I will also point out the depth of the macro drawdown now is quite significant. So it's kind of like, again, I forget whose note it was, but they referred to like demand bouncing along the bottom. And I'd say that's kind of like generally what we would think it roughly is, but you can't predict the macro. So that's why we focus more on the internal execution, on the recipe. We focus on, the internal drivers that we know will let us take share, that will let us outcompete others and do well regardless of what the market size is. And we've, just in this quarter, to date, so not the fourth quarter, but the first quarter, our market share is, has continued to climb. So we're still hitting all-time highs. We're continuing, meaning we're climbing. We're hitting new all-time highs.
Yeah, so thank you for the question on capital structure. As you pointed out, we've made significant changes in the profitability and the free cash flow nature of the business. And that broadly gives us optionality around capital structure. So as I said in the prepared remarks, one of those options actually is to pay the 2025s off in cash. And, we think that is a good and viable option. That said, we're very focused on what is most economically efficient for our shareholders and best for the business, and we intend to be prudent and thoughtful. And so we continue to vet a wide range of options, from cash payment to refinancing to a combination. With regards to your question on timing, it's worth noting that each quarter that our financial profile continues to improve and our free cash flow generation improves, obviously the cost of capital for us continues to come down. And so there is some benefit there to the timing as well.
Very helpful. I appreciate it. Thank you.
Your next question comes from a line of Anna Andreeva from Needham. Your line is open. Anna Andreeva, your line is open.
Oh, apologies. Good morning, guys. Thanks so much.
Good morning.
Can you talk about if you're seeing anything different with demand across various household incomes? Is it the lower income consumer that's more pressured so far in 1Q? And also curious on performance of other high-margin brands in the portfolio outside of core Wayfair banner. How did the specialty retail and the Wayfair professional perform? That's either in the fourth quarter or so far quarter to date. Thank you so much.
Thanks, Ann. So a few thoughts on that. So first, you do see demand get increasingly pressured as you move down the income levels. So obviously you would expect that, but we see that in our data, and we also see that in the macro data we get from particularly some of the banks, the credit card companies. So I'd say that trend is pretty clean and pretty obvious. And so, I think there's nothing surprising to that, though. Then in terms of our brands, when you talk about kind of our brands, the specialty brands, which kind of play kind of above mass, and then the luxury platform Perigold, which plays above that, you're seeing that those higher end ones are doing quite well. And Perigold, I mean, the luxury market is much less competitive, but it's growing at very significant rates. And part of that is it's smaller than Wayfair, but we have small market share everywhere. It's just that's a relatively young brand for us. It's executing very well, and as we mentioned a minute ago, that higher end market is less pressured, so it's a much better place. But it's growing, significant growth rates.
Your next question comes from a line of Colin Sebastian from Baird. Your line is open.
Thanks, and good morning. I appreciate the opportunity. Maybe one quick follow-up on the last question around customer segmentation. I know there's a lot of curiosity around emerging competition in e-commerce from Asia, including expansion of the home category. If that's something that you foresee impacting prices or customer acquisition costs, or is that more likely limited to the lower end consumer segment? And then maybe secondly, in the shareholder letter, I was intrigued by some of the comments on logistics around additional services that you're building on top of that infrastructure, and just curious for maybe a little more color on, is that adding new revenue opportunity, or is that more about creating additional efficiency? Obviously, in terms of competitive differentiation, there's some interesting stuff happening there. Thank you.
Thanks, Colin. So first, on your first part of your question around the customer segmentation, and I think basically your question is sort of like the kind of growth of Temu and Shein and TikTok Shop, and so what role do you see them playing from a competitive standpoint for us? What I would say is what we're really seeing is where they compete is at the very low end of the market, both low end kind of quality-wise and kind of ticket size. And so that's where their volume is. That's what they're known for, kind of with customers for. I think that's where you see Amazon obviously lowered their take rate at the low end of certain categories, I think, because of kind of how the holiday competition there with those folks were. And I think some of the other folks who sell kind of smaller odds and ends kind of, referencing, we have not seen them really be a competitor in, we go focus in home. Many people have a home business. The question is, what do they really sell in home? What are the subcategories and what tranches of them, that do they really play in? And that's where you start seeing, the Venn diagram overlaps end up not being necessarily very large in certain places, and they are much larger in other places. So we have not seen these folks be competitors. Also, some of them are very large advertising spenders, and we have not seen them really be a player in when we look at the share and who our competitive set is in certain of the lower funnel advertising, things like Google PLAs and Google Search, or some of these things that are highly targeted and high intent. We don't see them being players there. And as you go upper funnel, things like display or things like television, these are vast markets where no one competitor or two competitors move that market, and you're not necessarily competing with named specific competitors, that those markets are more broad. So we haven't seen them be competitors. Now, we obviously watch all our competitors and what they're doing and how things are evolving, but we feel very good about what we've built for differentiation in home around the shoppability, around the delivery and logistics, around a set of things that, frankly, or, unless you focus on these bigger, bulkier items and the home goods in particular that are prone to damage, I don't think you can necessarily, tackle those things very easily. So we feel very good about that. And then to touch on the second part of your question on logistics, and you said, hey, You know, in the shareholder letter, I talked about logistics for a little bit, and you talked about, you know, do these create revenue opportunities or do these create cost efficiencies? Well, the answer is they can create both. And, you know, just one example I'll highlight, which is kind of a service offering that makes a lot of sense for us to provide, doesn't make a lot of sense if you don't focus on like our categories very deeply, would be something that's relatively new, but we've been working on and we'll start to roll out, which is consolidated delivery. So in consolidated delivery, it allows you, you know, whether you're moving houses or you're doing a renovation or you're an interior designer doing
Please
a project
tap the
for a
like
client,
button to share this video
or,
out.
you know,
Thank you
if
very
you
much.
want all the items for your
Nicola
bathroom remodeled,
earnings
or contractors
following
show up,
this
at a given
earnings.
day, or you're helping your son move into an apartment. You can basically order a set of large and small items, pick a date in the future that you want them all to be delivered, and they can then be delivered at the same time on that date in the future. So from a customer standpoint, you can see how in certain use cases that's incredibly convenient. It'd be very helpful for the customer for that to happen. And so you can imagine then the customer would be inclined to buy more of those items for that use case or that project from you because it's going to be easier. They'll all come together at the same time. And so maybe you wouldn't have bought that coffee maker from us, but if it's going to be one of the many items you want delivered at the same time, you might as well just buy it from us instead of buying it somewhere else, even though it's more of a, say, a commodity item or what have you. So you can see that growing revenue. But then from a cost efficiency standpoint, as you can imagine, delivering things one at a time is less efficient than delivering a lot of things all at once. And so when you have a logistics network where we have fulfillment centers, we're picking up from suppliers, we have over-the-road transportation, moving goods down the chain towards where they're going to be delivered from, we have these delivery terminals. Given that we have that infrastructure, you can then with software, you know, which you have to build, which is, you know, complicated, but as you have that, you can actually lower your cost of delivery while improving the customer experience and growing revenue. So you get these combination effects. I picked one that happens to just be an easier one to explain, but there's a lot of other benefits and the various things we're doing. So we think the logistics runway is a real one. It's significant, and it still has a lot of room for us to build kind of good customer experiences there.
Great. Thanks, Neeraj.
Your next question comes from the line of Christopher Horvers from JP Morgan. Your line is open.
Thanks. Good morning, everybody. So as you think about a couple questions. So first, as you think about the flat scenario and $600 billion plus of EBITDA, can you help us think about, you know, how that plays out down